If I give you two balance sheets, one at the beginning of the year and one at the end of the year, how would you calculate the EBITDA for that fiscal year? I'm going to walk through this step by step, and then we're going to go over all the assumptions you need to make sure you answer this question correctly. So we know that EBITDA is in the middle of the income statement, right? It's between your revenue and your net income. Well, when we think of what we're given the balance sheet. And what's the one thing that's always going to be reflected on the balance sheet, especially if it's the change from one year to the end of another year? Well, it's going to be your retained earnings, right? Because it's your revenue minus your expenses minus your dividends equals your net income. The first assumption you need to make is that there are no dividends, right? So it's just your revenue minus your expenses, which means that change in retained earnings is going to be directly equivocal or directly equal to your net income that you got that year. So you can start with your net income, and then from there, we know to get to our EBITDA, we just need our interest, taxes, depreciation, amortization. You have to assume that there's a fixed or not changing tax rate, and also do the same for interest, and that's going to work you back up to your EBIT. From there, all you have left is your depreciation and your amortization. So assume that there's no extra investments in PP&E or capital expenditures or the changes in intangible assets that you're purchasing, you can work back that change as your amortization and your depreciation to get your EBITDA. Now, with any investment banking technical, especially one like this, it's important to make sure that you state your assumptions because if those assumptions are not there, then this question is not true, right? We are assuming that there's not any losses or just sales of any of the assets. We are assuming the tax rate. We are also assuming that there's no asset write downs, and we're also assuming the interest rate of the debt and no dividends or capex. If you have a question about this, feel free to throw it in the comments.